Where can you still get 6% bonds, especially with short-term rates coming down? Hello, Diamond NestEgg members, super savers, and course fans. I hope you're healthy and well. So, the Fed cut rates by 25 basis points this past Wednesday, bringing the Fed funds rate down from its previous range of between 4 and 4.25% to the current range of between 3.75% and 4%. This cut had been widely anticipated and surprised basically no one. But as so often happens in life, the moment one question is answered, another set of questions comes up. And it was no different this time. After the rate cut announcement, our members, as well as many market observers, almost immediately focused on two other topics: the end of quantitative tightening that Chairman Powell announced on Wednesday as well, and how to read his comments about the likelihood of an additional rate cut at the next FOMC meeting in December. So, with that in mind, here are the three topics that we'll be covering today. 1. What does the Fed rate cut and the end of quantitative tightening mean for Treasuries and other bonds? 2. How do current rates compare for Treasuries, agencies, and annuities? And 3. What are the predicted yields for the upcoming week's Treasury auctions? And in this section, we'll also share with you a 6% new issue corporate bond opportunity that one of our Diamond NestEgg fans sent our way. Some of you may find this interesting. Let's dive in now, folks. What does the Fed rate cut and the end of quantitative tightening mean for Treasuries and other bonds? So let's take the three main messages that Chairman Powell had for the markets on Wednesday, one by one. First, the rate cut. This one is relatively straightforward. As I said before, analysts had widely expected a rate cut by 25 basis points, and the markets liked what they saw. Both the S&P 500 and the NASDAQ were up slightly for the week. In fact, the NASDAQ set its longest streak of monthly gains since 2018. Treasury's reaction was more complex, as so often in the current rate cut cycle. Yields were down at the short end, but up at the long end. More about that later. Second, the end of quantitative tightening. Now, this hasn't happened yet, but the Fed said that as per December 1st, it will stop shrinking its balance sheet. This sounds technical, but what it means is the following. Until recently, the Fed kept selling some of the treasuries and agencies that it owns, which had the effect of reducing the amount of cash in the economy, like withdrawing banknotes from circulation, so to speak. This makes cash scarcer in our economy, which is essentially the same effect as a rate increase and can help fight inflation. If you want a deeper dive or refresher on quantitative tightening versus quantitative easing and how the Fed balance sheet works, please refer back to this recent video from Marcus, linked below in the first pinned comment for your convenience. So from December 1st, the Fed will keep its balance sheet stable, meaning that the amount of cash in circulation will stop shrinking, which should work in the same direction as this week's rate cut, bringing lower rates and easier access to credit, which in turn should stimulate the economy, help the economy grow basically. So far, so good. But now comes the interesting part. The Fed also said that going forward, it will reinvest all principal payments from the Federal Reserve's holdings of agency securities into Treasury bills. This prompted one of our members, Ann, to ask us to explain what this means. Should investors follow the Fed into T-bills, or on the contrary, should investors be on the lookout for good opportunities to pick up agencies at lower prices and higher yields? So, the Fed currently owns roughly 10% of all outstanding bonds in the U.S., a sizable $4 trillion in treasuries, and an additional $2 trillion in agencies. In the past, when an agency bond matured, the Fed took the principal repayment and bought a new agency bond with it, keeping its holdings of agencies stable. Going forward, it'll use the principal repayment from the agency bond, the money it receives when the agency bond matures, to buy treasuries instead, and specifically T-bills. In other words, All agency bonds on the Fed's balance sheet will gradually mature and not be replaced with agency bonds. Instead, those agency bonds will be replaced with T-bills. This in itself is not that surprising and is not a vote of no confidence in agencies in our mind. The Fed has always said that it wants to own primarily Treasuries on its balance sheet as the safest and most liquid instruments in the world. The massive buildup of agency bonds only began when the Fed started buying mortgage-backed securities from the likes of Fannie Mae and Freddie Mac during the Great Financial Crisis, and then again during COVID to support the housing market. So the shift back to Treasuries may even be a sign of normalization. That said, the question that our member Ann asked is a valid one. When the Fed starts shifting its $2 trillion of agencies into T-bills and piles that on top of the $4 trillion in Treasuries that it already owns, should these massive amounts not mean lower prices and higher yields for the agencies that are getting dumped, and higher prices and lower yields for the T-bills that the Fed will be buying? Chairman Powell got basically the same question in his press conference, and he tried to calm everyone down. Of course he would. That's his job.
Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions.
As we always say at Diamond NestEgg, no one can predict the future. But if the Fed makes good on its promise and moves very slowly, the impact on prices and yields should indeed be limited and gradual, both for T-bills and agencies. It will take time for any effects to be felt, and it shouldn't turn the world of bonds upside down. So this is not a reason why Marcus and I would be changing our long-term bond investing strategy fundamentally. Of course, we also would not be surprised if this created some downward pressure on T-bill yields if the Fed were to move a bit faster, especially given the significant volumes involved. $2 trillion is a large amount to move from one type of bond into another, and especially for agency-issued mortgage-backed securities, where the Fed's shift will affect roughly 20% of the total outstanding volume. So there might be some buying opportunities for agency-issued mortgage-backed securities in the future, as we, the general pool of retail investors, start to feel the effects. Mortgage-backed securities are more complex products though, so leave a comment below. Are you interested in learning more about them? We'll see if we can add them to our list of future videos if there's enough interest in our community. And as for the third main message that Chairman Powell had for the markets on Wednesday, and this one was a bit surprising for quite a few folks, another rate cut in December is not necessarily a given. As our Diamond NestEgg regulars have heard us discuss on this channel before, the Fed is currently caught between a rock and a hard place. An inflation rate that seems to be stuck around 3%, above the Fed's declared 2% target, is calling for higher rates, while at the same time, a softer labor market is calling for lower rates to stimulate the economy. So, what do you do in such a situation? Reasonable people can disagree here about what to prioritize, and that's what seems to be happening in the FOMC as well, according to Chairman Powell.
They're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
At the current time, according to the CME's Fed Watch tool, 70% of market participants are still expecting another 25 basis point rate cut in December. But 30% now think that the Fed will keep rates where they are into 2026. And this is understandable given the warning signs from Chairman Powell that we just discussed, that the Fed might not necessarily cut rates any further if they feel that the labor market and the economy are on their way up again, or if they fear that a further rate cut would be a danger to price stability, meaning inflation. Of course, if you do fall into the camp that believes short-term rates will continue to come down, and you're now thinking of locking in medium and longer-term rates before those might move in a similar direction, Then our rate comparison in the next section of today's session might be quite interesting for you. How do current rates compare for Treasuries, agencies, and annuities? As we normally do at the ends of the week, let's compare the annuity, agency, and Treasury rates at the time of this taping, going from the highest rates, annuities, to the lowest rates, which for today is Treasuries. As I've mentioned in our annuity series this year, annuity rates and payouts are largely driven by interest rates. And because interest rates have been at decade-plus highs the past few years, annuity rates and payouts have also been at decade-plus highs. In this section of today's session, we will be focusing specifically on rates for MYGAs, multi-year guaranteed annuities, as they are most similar to the Treasuries and agencies that we're talking about here, and it's also what many of you in our community hold in your fixed income portfolio. As a reminder, a MYGA is a fixed deferred annuity. Basically, you invest a lump sum for a set term, typically 2 to 10 years, and earn a guaranteed interest rate with the principal and all accumulated capital paid out at maturity. There are no regular interest payments. Rather, a MYGA offers principal protection and steady growth, like a certificate of deposit or CD, but requires reinvestment decisions afterward. A MYGA does not generally offer guaranteed lifetime income at the time of purchase. So, let's begin with some sample rates for MYGAs from a AA+ rated insurance company that we work with. Here you have the investment amount, and for each investment range, here's a rate for a 2-year MYGA, 3-year MYGA, and so on, all the way up to 7 years. For example, if you were to purchase a $10,000 7-year MYGA at the time of this taping from this carrier, your rate might be 4.35%. A $50,000 7-year MYGA might earn you 4.45%, and a $100,000 MYGA might earn you even 4.6% for 7 years. The good news for those of you who are still thinking about MYGAs is that the MYGA rates have pretty much stayed stable over the past 2 weeks. They're still at attractive levels, especially for the longer maturities. And if you are considering an investment of $1 million or more, you could even get a bit more than this 4.6% that's shown in this table. Do keep in mind that the MYGA rates in this table are subject to change at any time without prior notice, and that your personal rate may be higher or lower depending on how strongly or not so strongly the insurance company you're buying your annuity from is rated. It'll also depend on your investment amount, annuity type and term, state of residence, and other circumstances. Your personal rate is not fixed before you sign your annuity contract. Now, let's see how these MYGA rates compare to agencies and Treasuries, both of which are more liquid than MYGAs in the sense that you can sell them on the secondary market before maturity at whatever the then prevailing market price may be. Remember that MYGAs usually only allow you to withdraw some part of your capital per year without penalty. For example, 10%. You will need to pay an extra surrender charge that is not insignificant if you need more liquidity beyond that amount. A 10% IRS penalty may also apply to the portion of your annuity withdrawal that is considered earnings if you're under 59.5, which is the flip side of the tax-deferred treatment on annuities. So, as this table shows, the rates on agency bonds range from as low as 3.62% for a 2-year term up to 3.97% for a 7-year term, up a bit from the previous week. Do note that these rates are for non-callable agencies only to make it comparable to MYGAs and Treasuries. Callable agencies may show higher rates, but they are not locked in beyond the first possible call date, which is something to be aware of. And the rates on Treasuries range from as low as 3.6% for a 2-year term up to 3.89% for a 7-year term. And what we see here is somewhat similar to last week, that for a 2-year term and for amounts under $100,000, the rates on MYGAs, agencies, and Treasuries differ by only a few basis points. For a 2-year term with amounts $100,000 plus, and for anything longer than 2 years, the MYGA rates continue to win over agencies and Treasuries, and more substantially so the further out you go and the more you invest. But just to remind you, you'll need to be comfortable with the illiquidity of MYGAs, as well as a lack of regular interest payments if you want to lock in these rates for the long run. So, If you've been thinking about annuities either for the principal protection and higher rates or for the guaranteed lifetime income that they can offer, now may be a good time to reach out to your trusted annuity specialist. Or shoot us an email at jennifer@diamondnestegg.com so that we can connect you with our trusted annuity specialist to see what your options may be. Because as I always say, everyone's financial journey is different. Now, for our Diamond Nest Egg regulars who are considering fixed indexed annuities, FIAs, rather than MIGAs, you'll be happy to hear that these attractive FIA rates that we shared with you a few weeks back have also held stable so far. Remember that while FIAs and MIGAs are fixed deferred annuities, they serve different purposes. Instead of paying a set interest rate like a MIGA, with a FIA, most investors choose to tie their growth rate to how well a stock index like the S&P 500 performs up to a certain maximum limit, but with guaranteed return of principal. So if the market goes up, the FIA buyer gets part of the gain, up to a maximum cap. And if the market falls, the FIA buyer still gets his or her original principal back and any interest already earned. Think of it as a middle ground, safer than investing directly in stocks because, well, no losses. The principal is guaranteed, but with a chance for higher returns than a MIGA, agency, or Treasury. So, if we go back to this rates table for fixed index annuities, for a 7-year FIA, the first year interest rate on the fixed bucket is still 4.25%, and the percentage cap on the S&P 500 index buckets are also still ranging between 7.25% and 10%, depending on whether you're locking in the cap rate for just 1 year or for the full 7-year term of the FIA. Again, as Marcus often says, annuities come in many flavors. So if you want to learn more about how FIAs work, check out this Fixed Index Annuity 101 video for more details. Moving on now to our usual table with Treasury yields from this past Friday versus the previous week across all the maturities that the Treasury issues at auction. This last row here shows the increase or decrease in rates over the past week. Increases in rates are shown in black and decreases in rates are shown in red. As I mentioned before, we're seeing the same picture here that we initially saw after the last few rate cuts. The shorter maturities, 4 months and below, are generally down week over week, with the single exception of the 2-month, which moved in the opposite direction. So the short end of the Treasuries, overall, is following the Fed rate cuts here, as it should. For all maturities 6 months and longer, yields went up though, and noticeably so this week. Now, as we've talked about before on our channel, the Fed doesn't control the medium and long end of the yield curve, which is pretty much defined by the forces of supply and demand in the market. And as we've said as well, very often, though not always, the yields on Treasuries with longer maturities tend to go up immediately after a rate cut. And this is what happened again this week, as you can see. The reasons for these higher long-term yields after a rate cut are not always clear. It could be the expectation that the economy will start picking up speed again after a rate cut, or it might be the fear of higher inflation, or maybe a bit of both. In any case, though, these higher yields at the long end after a rate cut may or may not last. This depends really on how the economy does. If it starts to grow again, and or if inflation starts picking up again, the long-term rates may stay high, or go even higher. But if the economy continues to weaken and or inflation is coming down, then long-term yields may reverse course and start coming down as well. We don't have a crystal ball, unfortunately, and neither does the Fed. But if you think that long-term yields may be coming down again, then now might be a good time to buy some longer maturities to lock the rates in, or to add some longer maturity Treasuries, agencies, annuities, or other types of bonds to your portfolio as you continue to dollar cost average. It really all depends on your personal outlook. Now, let's take a look at Treasury yields from this past Friday versus the beginning of the year. As before, this last row here shows the increase or decrease in rates since the beginning of this year. Decreases in rates are shown in red. In line with what we just covered earlier, yields at the longer end of the maturity spectrum are still below where they were at the beginning of the year, but they have narrowed the gap. The 30-year is now only 12 basis points below where it was on January 2nd. And for the 20-year, the difference is 21 basis points, which are quite attractive levels when we compare them to what we had over the past 20 years. And it's not that different in the middle and at the short end of the maturity spectrum. Overall, rates are still at an attractive level for investors compared to the past 2 decades. You can find more details on these Treasury rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Keep in mind that these numbers give you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. So, now that we have a good overview of where rates ended the week, let's move on to the next section of today's discussion. What are the predicted yields for the upcoming week's Treasury auctions? If we go to Treasury Direct's upcoming auctions page, we can see that the 13, 26, 6, 17, 4, and 8-week T-bills are happening as usual. Other than that, it's pretty quiet on the auction front this coming week, with no T-note, T-bond, and TIPS auctions on the schedule. At the time of this taping on Fidelity's platform, here's where the expected yields stand for the T-bills that have been announced already. The 13-week at 3.808, the 26-week at 3.714, and the 6-week at 3.910. And congratulations to all our iBond fans who picked up iBonds before Halloween and grabbed the previous iBond fixed rate of 1.1%. Exactly as we predicted in our iBond video last week, the new iBond fixed rate is lower at 0.9% for all iBonds issued between November 1st, 2025 to April 30th, 2026, with a combined iBond rate of 4.03%. Now, for those of you in our community who are willing to take on a bit more risk for a bit more return and who don't mind callable bonds, there are still a few interesting opportunities out there if you're willing to look, like our Diamond NestEgg fan David does. So, as promised at the beginning of this video, here comes the tip that David wrote in and shared with us. BBVA currently has 6% new issuance bonds on Schwab with a November 17th, 2047 maturity date, and another one with a November 17th, 2050 maturity date. Over the past few months, I've been buying in the 21 to 25 year maturity range. These are easy to miss, to overlook, as they're not in the 20 or 30 year drop-down list and can only be found by doing a detailed search. Many thanks to David for sharing his find with us. For those of you who may not be familiar with BBVA, and honestly, I can't pronounce their full name, so BBVA it is. BBVA is the second largest Spanish bank. The company is officially based in Bilbao, the Basque Country in the north of Spain, but its operational headquarters are in Madrid. BBVA is well known for its retail and corporate banking services with 80 million customers in Spain, Europe, and Latin America, including Mexico, and has total assets of more than $900 billion. BBVA is rated solidly investment grade by both S&P at A+ and Moody's at A2. That said, it's currently not large enough to be a GSIB, a global systemically important bank, and has more generally always been standing a bit in the shadow of its larger and better-known Spanish competitor, Santander. And maybe that's exactly the reason why they're currently offering these attractive rates on their bonds. If you're interested in checking out the BBVA bonds that David mentioned, the CUSIP for the one with a November 17th, 2047 maturity date is 05556NTY2. It has a first call date in November 2026. And the CUSIP for the one with a November 17th, 2050 maturity date is 05556NTV8. It has a first call date in November 2027. The 6% coupon on both of these bonds is paid annually, and we were able to find both of these CUSIPs on Schwab and Fidelity, but not on Vanguard. So drop a comment below and let me and the community know, what are you buying currently in November? T-bills, T-notes, T-bonds, agencies, corporates, or annuities? And on a separate topic, How long do you think this government shutdown will drag on for? And as always, if the annuity rates in these tables have piqued your interest, do check out these annuity videos here or drop us a note at jennifer@diamondnetsegg.com so that we can connect you with our trusted annuity specialists, because annuities are not always straightforward. As I mentioned earlier, any annuity you purchase should be customized to your individual circumstances, goals, and expectations, and fit properly in your overall portfolio, regardless of size. All right, Diamond NestEgg members, super savers, and course fans, I hope you enjoyed today's session and learned something new. And see you again very soon with more brand new wealth building content for your financial journey.